Welcome back to the Explainer-Focused Learners. Today, we're totally bypassing the textbook, strapping on our detective hats, and stepping straight into the high-stakes world of financial auditing. We are tackling an absolutely massive topic from your ICAI syllabus, Standard on Auditing 570, better known as Going Concern. By the end of this, you won't even need to go back to your books for conceptual clarity.
Okay, let's dive into this. I want you to imagine you're an auditor walking into a company. The lights are on, the machines are buzzing, everything looks totally fine. But what if, behind closed doors, the whole thing is just falling apart? The ultimate, absolute most crucial question you have to answer is, will this business actually survive the next 12 months, or is it secretly on the absolute brink of collapse? Well, that is exactly what SA 570 is designed to help you figure out.
Here is our roadmap for the case today. First up, the going concern assumption. Second, spotting the red flags. Third, the investigation. Fourth, the final reporting verdict. And finally, number 5, your ICAI exam arsenal. Stick around, because by the end of this explainer, I'm going to hand you a memory trick that will basically replace your textbook for SA 570.
All right, let's get into Section 1, the going concern assumption. We need to lay the foundation and look at the absolute baseline expectation for literally any functioning business. So here is the exact, precise ICAI definition you need to know. The going concern assumption basically means we expect an entity to just keep continuing its operations for the foreseeable future. Simple, right? But the absolutely crucial second half of that definition is this. A company is a going concern as long as management has no intention and no necessity to do 3 very specific drastic things: liquidate, cease operations, or seek protection from creditors. If they aren't planning to do any of those 3 things, the assumption holds up.
Now you might be wondering, what exactly does foreseeable future actually mean in the real world? Well, I need you to burn this number into your memory right now, 12. For audit purposes, the foreseeable future strictly means at least 12 months from the date of the financial statements. Remember, that's not 12 months from the day you, the auditor, show up. It's 12 months from the actual reporting date.
Now, what's really interesting about this slide is how clearly it draws the battle lines between what management does and what you do. Management's job? They have to assess their own ability to survive. They prepare the statements, they identify their own doubts, and they make the disclosures. Basically, where their job ends, your critical evaluation begins. Your job as the auditor is to evaluate their assessment, hunt down the evidence, form a conclusion, and issue the final report. You aren't doing the assessment for them, okay? You are essentially grading their homework.
So why does this distinction matter so much? Look at the stark contrast here. Under a normal going concern basis, you get the comfort of valuing assets at their normal carrying amounts, and liabilities are just settled on their normal everyday schedules. But if that assumption fails, you are instantly thrown into the liquidation basis. Suddenly, the business is closing. Assets have to be written down to whatever net realizable value you can scrape together in a desperate fire sale, and liabilities, they demand immediate settlement. It's literally the difference between a normal, functioning company and a complete financial bloodbath.
Section 2, spotting the red flags. If a company is secretly heading toward that liquidation bloodbath, how do we spot the clues before it's too late?
SA 570 groups these clues into 3 buckets. First up, financial indicators. I want you to visualize a company just bleeding cash. You're going to see continuous losses, negative net worth, negative operating cash flows, and then watch what happens to their lifelines. They start defaulting on loans, their creditors are severely overdue, and banks start pulling their support. When the math turns against them this hard, the going concern assumption is in serious jeopardy.
And this brilliantly illustrates that it's not just about the money. Operational chaos can be just as deadly. These are your operating indicators. Imagine a factory completely paralyzed by massive labor strikes or the sudden, out-of-nowhere resignation of the entire executive team. If they lose a massive customer or a key supplier suddenly cuts off all their raw materials, honestly, the business can tank just as fast as a loan default.
Finally, we have the other category. These are basically massive external shocks. A company might be completely financially sound, operating perfectly, but then, boom, they get hit with a devastating business-ending lawsuit. Or there's a sudden shift in government policies. Maybe their operating license gets revoked, a natural disaster hits, or a massive technological change makes their entire product line completely irrelevant overnight. As the auditor, you have to keep your eyes peeled for all 3 types of these indicators.
Section 3, the investigation. Once we spot these clues, we don't just panic. We have to execute official, methodical audit procedures. Let's see how.
Here is the structured, 4-step chronological process you absolutely must follow. Step 1. Grade management's homework. Evaluate their assessment to make sure they looked at least 12 months ahead and check that their assumptions are actually realistic. Step 2. Consider any events that happened after they made their assessment. Step 3. Do your detective work. Perform additional procedures like analyzing cash flows and reading board minutes. And finally, Step 4. Evaluate all the evidence you've gathered to make an informed, rock-solid conclusion. You're not predicting the future, you're evaluating the evidence.
So the crucial point is this. Spotting a red flag does not automatically mean the company is doomed. A red flag only escalates into what SA 570 officially calls a material uncertainty if it meets 2 strict conditions. First, the event has to cast significant doubt on the entity's ability to continue. Second, the potential impact of that doubt must be material to the financial statements. If you have significant doubt and a material impact, well, you've officially got a material uncertainty on your hands.
Section 4. The final reporting verdict. You've done the work, you've gathered the evidence, and you've found the uncertainties. Now comes the climax. It's time to sign your name on the dotted line.
Look, ICAI loves testing this, so study this matrix carefully. Let's break down the 5 exact scenarios. Situation 1 is a breeze. The assumption is appropriate and no uncertainties exist. You issue a clean, unmodified opinion. Boom, done. But what if a material uncertainty does exist? Well, that splits into situation 2 and 3. If management was honest and provided adequate disclosure in the financials, you still give an unmodified opinion, but you add a specific paragraph highlighting that material uncertainty. However, situation 3, if they try to hide it with inadequate disclosure, huge problem. Now you have to issue a qualified or adverse opinion. Situation 4, if liquidation is inevitable, meaning the assumption is totally inappropriate, but they still prepared normal statements, that is an automatic adverse opinion. No way around it. Finally, situation 5, if you just can't get enough evidence to even make a call, you issue a qualified or disclaimer of opinion. The main takeaway, the adequacy of management's disclosure is the absolute pivot point for your verdict.
Section 5. Your ICAI exam arsenal. You've mastered the concepts. Now let's focus purely on how you execute this perfectly on exam day for maximum retention.
When you are writing your answers, the examiner is literally scanning your paper for specific technical terminology. Do not use casual language here. You must aggressively use the exact keywords material uncertainty, management assessment, foreseeable future, significant doubt, and audit evidence. Honestly, sprinkling these highly technical terms throughout your answer is what secures you those top marks.
And to make absolutely sure you never blank out in the exam room, here is the ultimate payoff I promised you. To synthesize the entire flow of SA 570, just remember the word going. G, gather audit evidence. O, observe indicators, the financial, operating, and other ones. I, inspect management's assessment. N, note any material uncertainty. And G, give the appropriate audit report. 5 simple letters, and you've got the entire complex standard mapped out from start to finish.
We have laid out the rules, we've spotted the clues, we ran the investigation, and we handed down the final verdict. With that going framework and those vital ICAI keywords totally locked in your brain, you are fully empowered to step into that exam room and tear this topic apart. So I'll leave you with this final thought. Are you ready to ace SA 570 and prove you've got what it takes to be a top-tier financial detective? Keep reviewing this explainer, stay completely focused, and I will catch you in the next one.